All right, welcome everyone. Thanks for being here. I think it's interesting that on our panel today we've got two people that work in northern Canada in very remote areas, and we've got Sean O'Day, who works with Sonadix and is quite interested in microgrid solutions and investing in the renewable sector. So I think we heard earlier today from one of our panelists early on in the day that he referred to these as, I think he referred to them as stranded mines in the north, and that these mines in the north have some particular challenges, energy challenges that other mines don't face. And so what I'd like to start out with is just start with Bill here and maybe get a sense of what some of those particular challenges are that are particular to the north, and in particular northern Canada, and what those particular challenges might be.
Yeah, well, the obvious one is that you're usually not on grid power, and even if grid power is available or potentially could be available, building transmission lines in the north is very expensive, and the permitting process to build a transmission line would be very difficult. In our particular case, just to give an example, the Northwest Territories government has been talking about building power to the diamond mines for I don't know how long, 15 years or something. And it's not gone anywhere. There's all kinds of plans and maps and things like that out there, including just very recently talk about bringing power from the south part of Great Slave Lake, which has a surplus of power available up to Yellowknife and then across the diamond mines. But the problem with developing a mine is you can't depend on government maps and things like that. You need to know what is going to happen. And so basically you're on your own when it comes to power, and that's really the big challenge.
And Liesl, from your perspective?
Yeah, I think timing is key on everything. So once you've identified your resource, you want to get going, because the shareholder also wants his return. So to get the development going, is you're going to go with actually a lower risk, the option that's safest, that's well known, a bankable option, and in many cases, the workhorse diesel generators are still the go-to option. So depending on the size of the investment or the resource you want to develop, you need a base load that can map your load profile. That is the first thing, is you're going to have a certain load profile that needs to be reliably serviced. If you have a higher level of load or asset, that's where you can start to get creative and bring in more trial creative solutions. And I think what has changed over the past years is you might have a mine, and there are many options out there, but people have become a lot more, I would say, risk-taking or creative in picking solutions, not just go for the base case. And I think that is one of the changes that I've observed, is the base case has changed, and which is quite positive. But for you to get going, you need something that you can deploy fairly quickly, and then modularize and expand from there. And that's where renewables do have a good fit.
Great. And Sean, maybe you could give us or jump in on this. You mentioned sort of the diesel workhorse. Sean, what's the current thinking around diesel abatement and sort of the goals that you hear now around diesel abatement?
So Sonadix has traditionally been, or we're a solar IPP with our early projects, our traditional grid-tied PV projects supplying in the kind of active solar markets around the world. Regarding diesel abatement, our focus has been looking at, I guess, mining locations in different countries where, I don't know if they're stranded, they're always going to be stranded because they're smaller operations and they have no alternative. So our focus is to give them some options that fit their commercial profile and the length of contracting that, call them small to mid-sized mining operations, can commit to. and offer them some sort of a savings, and a guaranteed savings actually, is the way that we're proposing our solutions to reducing diesel costs. But you know, we're doing it with various solutions, but PV-only solutions and then integration of storage along with that is an option depending on the avoided costs that the mines are experiencing today.
Thanks. Bill, maybe you can give us a sense of what you're hearing in the north when it comes to diesel abatement.
Well, the commonest way is not really abatement, and that is to squeeze as much energy as you can out of the diesel, and that is by capturing the heat. And of course, if you're in the north, you have a lot of cold months. And so an advantage, in a sense, with diesel generation is you've got waste heat. And mines have got very, very good at capturing that waste heat and using it, because you need heat. If you have an underground mine, you need heat to keep the underground warm, and you have buildings to heat and so on. So that is actually the first area that people tend to focus on in terms of getting the most out of what diesel you consume, as opposed to reducing the amount of diesel you consume. I think that's the first area people go to.
And Lisa, what are your thoughts on diesel abatement?
Abatement is a different word we can use.
How about reducing the diesel use?
What we're chasing at the moment, and it's chasing, is you are continuously scanning across your energy areas where you use. So we talk energy efficiency, but some of it is also operation strategy. So how do you get your energy use down is not just saving by using less, it's productivity. So do you run at your maximum, especially in processing? Are you running close to your maximum demonstrated rate and getting your productivity up, your energy efficiency, and then when you don't have resource or ore, is shut down your plant and don't run. So one key option always with abatement or energy saving is your operation strategy, chasing productivity, efficiency, but real examples are you want to run your assets at its maximum efficiency, and if it's not run, shut it down and conserve. And this is something we tend to do a lot more in the north. Is you're not always going to have. It's fantastic if you have a stockpile in front of your plant and you can just run all the time, but it's not always like that. So you're always going to maximize your bottleneck, and where you don't have a bottleneck in your supply chain or your value chain, you're going to run it in a batch mode, or where you can get maximum energy efficiency out of it. So that is a free way of abatement.
Great, thank you. And Sean, let's talk a little bit about microgrids. I mean, what are the common barriers to microgrids, particularly in remote sites?
So the challenge that I've seen over the last several years in talking to, again, small to mid-size operations is the upfront CapEx or the tenor of a contract if we want to come in with a PPA solution. So I guess those are the two main factors that we've seen. So not to make it a commercial, but we're trying to come up with options to remove one of those barriers to allow the clients to embrace renewables. Maybe they won't have as large of a savings, but there will be a savings, and then we can expand that, or we can extend the contracts over time, and maybe change the economics of it. But it's to get them. I guess one of the previous speakers had a cartoon of a chasm, but to kind of reduce the width of that chasm, and if they do fall, it won't be very far, and to still offer them some guaranteed savings. So.
And Liesl, what are the barriers that you're coming across?
Mostly it's psychology. I think honestly the starting position is technology is there, so bank that is the decision-making processes of people that make those calls. That is the true barrier to me. The solutions that are available at the moment, we were talking earlier this morning about financial metrics, and they are absolutely key to get the economics over. But then second, right straight behind it, is the people that actually push these processes. And that is, I think, an invisible barrier that sits in this cycle is, do you have the right people that's going to push and hound and fight and find these opportunities and realize them? So as any company, not just mining, is you need to know if you have those hound dogs in your business that's going to go chase these things and break down the barriers, because a lot of these barriers are actually self-created, self-inflicted. So I'll just speak to that barrier. It's the barrier of psychology.
Great, thank you. And Bill, in your presentation, it was clear that obviously your company had some of those hound dogs in the company that was chasing down some options. What was the impetus for that?
Well, of course, what we did was very small scale, and in some senses, it was. You could say it was maybe to be green, but I did have financial arguments about why it was something worth doing. But the interesting thing is that the unexpected benefits, and you know, it's been mentioned that for the large projects at mining operations, there was an aspect of de-risking, and the way I see it is that actually the benefits that we got out of what we did at our project were not the ones that were anticipated at the beginning. The benefit of being able to change the type of heater and things like that because of the de-risking of the power in the camp. That's in effect what we were doing. But there were definitely side benefits at the early stage in that when people visit our project, that the fact that we had put a renewable energy system in the camp had a definite effect on people like community visitors and government visitors. And although that's not a direct financial benefit, and it's almost impossible to measure the benefit you get from that, there was clearly a benefit in that area. But the other thing I see that's important to think about is that you can take too linear a look at how things are financially calculated, if you like. And de-risking means having alternative ways of doing something. So in your own investments, you know, they typically say you should have 60% stocks and 40% bonds or something like this, even though stocks may give a better return than bonds. But the way I see it is that by having a mixture of energy sources, you're de-risking your project, especially when it's a remote project. And I think that's an important aspect, but very difficult to measure.
Sean, is there any particular mechanism that you use to measure the de-risking the project or the value of de-risking the project?
Well, I guess it's looking at the goals of the client and finding out what their real driver is for wanting to, you know, I mean, obviously if they're off grid, they want to reduce their costs. Depending on the person making the decision in the process, you know, it's, I guess I mentioned there's you know, either coming up with a term of commitment that can reduce their proposed risk, giving them off-ramps on the power purchase agreement with reasonable penalties, if or moving the price up and down on how we're going to price the power. I mean, those are the three big factors that we're seeing that move the clients closer to or away from you know, actually signing a deal with us. So,
Liesl, I just want to go back to the people. We talked a little bit about this at lunch. What do you think the barriers are? Why aren't there more companies with champions in the company that are driving renewables?
Ooh, that's a difficult one. I think they're there. I think they need to be empowered. I think, you know, there are great people everywhere. It's them finding, and I like the word resonance because I'm electrical, so, but it's them finding resonance. It's for leadership to spot, and your good people want the difficult projects. So they're out there, right? Even if, and it's not all about compensation. It's put the challenge out there, and you're going to find someone that's going to resonate with it, and they say, I want to do this project, and I come on board. And that's really how I got to join Divik. I was sitting back in Namibia, and I was working for Rio, and it came by question. And this is maybe the leading question here is, or comment, is people respond very well to questions. Put the challenging question out there, and see who resonates with that challenge. And that is how I think you get people stepping up that already have the potential and take on these challenging projects, because the people are there.
Excellent, thanks.
I can add something, if you don't mind, to that. I think what you're really talking about is change management. And I was previously with a large company where we implemented Six Sigma. And we had lots of mines all over the place with mine managers who were like gods in their little kingdoms. And basically, the Six Sigma came from above. It was going to be done. And so basically, out of our many, many mines all over the place, some mine managers had to be changed because they didn't buy into it and they weren't willing to do it. And, but you have to have the champion above in order for it to happen. If there's no champion above, it won't happen.
Great. Let's just change a little bit here and talk about hybrid solutions a little bit. One of the questions that I often hear is, has the intermittency has the intermittency question been managed with hybrid solutions? And maybe, Sean, this is something that you could speak to.
So to be clear, Synetics is not a technology company. We're a power producer. So, I mean, intermittency was solved a long time ago with diesel. And the reality is to completely eliminate diesel from this equation is going to be very difficult. Most certainly because if the sun doesn't shine or if the wind stops for too long of a period of time, the mine cannot shut down. So you have to have that certainty, and that stability of the gensets reduces the intermittency issue you experience with solar and with wind and primarily. So I guess the answer would be that it's been solved, but if you go to much more advanced systems where you're trying to integrate large portions of chemical battery storage or other forms of storage, and how you're trying to balance that and integrate diesel into that mix, there are technical challenges. We've seen other presentations on that, and there are a lot of good companies that have solutions out there. The cost of that solution and what you're offsetting will determine how much of it you can put in place in different jurisdictions, or locations.
And Liesl, how are you managing the intermittency?
I think if you put on a utility thinking hat, when you build up your supply curve, your building blocks, you leave your peaking plant at the top. I don't think it's anything different. You start with whatever can serve your base load, and your wind or solar or whatever product you add in is going to help you do your peaking component. But I do think storage does play a very nice leveling component into that. The intermittency thing really, to me, is more an issue of economics. If you model whatever you want to integrate renewable, it needs to pass the economic hurdles, because we know typically what the curve for these products look like. And it's going to give you a load factor or a capacity factor for the asset that you purchase. And if it passes the economic hurdles, knowing that it doesn't give you full availability like diesel does, then firstly you've passed the economic hurdle and you can add that in as a peaking plant. In our case, where we've added wind, we looked at other options as well. We've gone for the maximum that we could. So it is modular, but we've gone the largest that we could for an off-grid, microgrid solution, which again gives us a bit more predictability when you do add that peaking plant, as I would call it. But at the end of the day, if it's past the economic hurdle and you have a base case solution, the diesel solution, then again you can manage the risk very equally because you know what you're getting into.
And Bill, how are you managing that?
Well, I just say that Liesel's presentation earlier just showed that it exists and it can be handled, and that's the way it is.
It's just how much diesel you can mitigate, right?
I just want to add that is the power of data. 2 years ago it was stalking, now we've got nice data. The data helps.
We heard a lot this morning about cost and cost barriers. Could you provide any recommendations for people out there on how they might finance hybrid solutions, or what are there some options out there for financing hybrid solutions? Maybe Sean, we'll start with you.
So, I mean, there's a lot of factors. I mean, there's jurisdiction, the credit quality of the company, the tenor of the project, you know, what you're offsetting as far as your avoided diesel cost. I heard an example earlier of $2.50 a liter US for diesel. You know, I mean, honestly, in some of these locations, I don't know if you actually, well, I mean, it's always nice to bring leverage in and finance them, but some of the potential costs that renewables can bring in these remote locations is so attractive. Even if you can't finance them, it's still a very good investment. You'll find lots of entities out there that have varying appetite for riskier investments, for advanced microgrid opportunities. Maybe less to do with the credit quality or the returns on the project, and more about kind of social investing and well, for other reasons besides, you know, the highest return. Then you can look at entities like us or other companies who are willing to come in and take that finance risk and negotiate along or some period of supplying energy. And if it is a benefit to your operation, and you can save on your energy costs, you can use third parties to do that. It's a new space, and I think there's new models evolving all the time to try and overcome the hurdle, this finance hurdle, until technologies have been de-risked, people have a higher comfort level, companies are have more certainty that it won't interrupt their traditional legacy operation. So, anyway.
And Liesl, same question.
Yeah, I think we were in a slightly, Rio has a strong balance sheet, so we were able to get financing, but the key thing is still needs to make its way in the competition hierarchy of projects. But here's the one thing. It might be on the, so I'm not going to speak only on the financing, also on the value driver that is an input to the finance debate or argument when you put your project forward, is sometimes your operation is structurally so set that you need some kind of change to structurally change your cost base. So we all chase continuous improvement and cost-saving projects and Lean Six Sigma, and we try and get as close to optimization, but your structure is locked. What you can do to get your next tranche of cost savings and hence unlock the financing is a structural change in your cost structure. And these projects, if you can prove that this can give you a change in your cost structure, which in our case it did, you have extremely strong argument again. So if you've not done the optimization and you haven't sweat out your asset as much as you can, there's other things you need to do before you want to invest in capital. So operational efficiencies, but that thing on changing your cost structure by using different energy resources is a very strong lever to get financing.
Right, and Bill, I guess at the company your stage, how do you bring investors along?
Well, the cost structure side of things, it's the objective with a small company is to try and get the capital cost of a project as low as possible. And so you're looking for people who can provide power and take on some of that risk for you to lower that capital cost, because that's what you're going to have to finance, and you don't finance internally, you finance it through equity. And basically you're driven by what the rate of return and the net NPV of the project's going to be, and that is how you'll raise the money on the market. And that's what the investor's going to be looking at, and the de-risking of the project when you're going to get an investor to invest in the capital side of the project.
Just on the investor side, in including renewables into your project, does it attract a different kind of investor? Does it attract a new investor? A new investor?
I think for the smaller companies, it actually can detract from the project because they see that as a risk, and they don't want any risk if they're investing in a project that a small company would be building. So actually, I'm guessing that it would have to some extent a negative effect, not a positive, and unless you could show very, very good data showing the financial benefit of doing it.
Great. Okay, this is the crystal ball question. If you all had a crystal ball and you're looking into it, what does the future look like for energy with remote mines? Lisa, we'll start with you.
I might be thrown out of the conference for saying this, but one option, honestly, is these modular nuclear reactors. So now I'm seeing who's throwing me out, but there's just not a legal framework for it. Talking about intermittency in the north, I've seen them work. They're pretty neat solutions. So my crystal ball, I like modular nuclear reactors, 10 megawatt units, 15 megawatt units. To me, that's one option way down the line. We just need a legal framework for it. The other thing, I do see diversity in the energy mix, for sure. We're in discussion with the G&W at the moment, again, just to push the renewable envelope, especially for communities. So not talking even mines. Off-grid communities, they can grow their own vegetables. The thing is, these communities are a lifeline to the mines that are far away. So we tend to think communities, not just mining operation, and how this umbilical cord is working. And if you can help solve that community's energy needs, and that's where solar is a fantastic opportunity for growing own greenhouse products and just getting their costs down, keeping people in the communities where they want to stay, and going up the curve there. I think it's all part of our diversification of moving towards not just, in our case, wind, but also solar, et cetera, things that's still coming that we have not even discovered. So that's my crystal ball.
Great. And Sean?
So I guess Moore's law, as it applies to, I guess we've seen what's happened in the last 10 years in the cost down, the rapid cost down and the cost of implementing solar. And I'm seeing the exact same thing in the solid state energy storage space, where especially in a diesel offset strategy, there's very promising solutions that will be cost effective and I believe bankable by 19 or 20. So we have a lot of hope for that, and we're betting on it actually. So.
And what do you predict, Bill?
Well, I think back that maybe 5 years ago, if you mentioned renewable energy at a mine site, people would laugh at you and think it was a joke. Now it's taken seriously. But if I look very quickly through the registration list for this meeting, and it's about 250 people or 40 or something, and about 60 are miners from the mining industry. So we've got 60 out of about 240. We'll really know that it's reached a sort of total acceptance when that ratio is reversed. And you've got like 150 mining people and maybe 100 people in the supply side and energy side and so on. But I think it's inevitable. I have complete faith that renewable energy is going to be a key part of remote mining projects within 5 or so years, because there's the pioneers, the Raglans and the Diaviks, that are proving it for the Canadian North, and that's what was needed. Somebody who had enough money to go out and just do it anyway and prove that it works.
And maybe a last question before we take questions from the audience, but what are the barriers? Why aren't there 150 miners in the audience? Lisa, what do you think the barriers are?
Core business.
Sure.
It's already such a complex industry we're in. If you mining, processing, in our case, supply chain, our mines, one mine in so many places. You've got to pick your battles. And there's a lot of battles to pick where you're going to put your attention. And so that I think that is my observation, is the attention is in other areas that demands that.
And Bill?
I guess, yeah, the mining industry is going through very tough times right now, so people don't go to conferences that easily anyway. But also, I think it's just time and change and acceptance, and that there's just that time has to, and there's the pioneers, and there's the people who follow, and they will inevitably follow as time goes by. And it's the same as within a company. There has to be a champion. It's in the whole industry there has to be champions as well, and that's what the pioneers are champions of that. For us as a company, we had a special vested interest in a sense. Our main project is a rare earth project, and rare earths are used in all kinds of energy-saving areas in permanent magnets. And we said, we've got to be looking at these things. We can't build a rare earth mine that is totally just using diesel. We should be looking at alternatives, because that's the business we're in. It's hard for us to say we're mining these materials to make permanent magnets to do hybrid cars and wind turbines and things like that, and then not have anything like that at the project.
And Sean, what do you hear? What are you hearing?
So I think it's, I mean, both the other speakers mentioned it, but it's risk perception, cost, and really focus on their core business. And I think right now, commodities are down. The idea of investing in what may be assumed as an expensive or exotic solution may not be seen as a good way to spend their time. And I think it's rapidly changing, though, and it's just a matter of time where more and more projects will come online. You'll have more documented cases of, that they are cost effective, that it is a good solution. The social responsibility mandate will percolate through the boardrooms of the major mining entities and work its way down to the smaller entities where, they're just, they're even more susceptible to the fluctuations. And ultimately the economics of the projects working and being de-risked it'll drive adoption. So
great.
And a free conference would also do it too. There'd be a lot of guys here.
Yeah. That's great. Why don't we take some questions from the floor? If anybody has any questions, I can't see, so I see a hand up right there. Right in the middle here.
Hi, I guess I'll ask a couple questions because they need to be asked. No one's asking any questions. For Scott, I mean, we haven't heard from anyone today, substantively, except for the detailed costing of the exploration camp. But what is the cost to produce a megawatt of solar power today? And maybe what was it 3 years ago when this conference started? And what do you see it next year? And I guess that the follow-up.
Everyone calls me Scott. My name's Sean, but okay.
Okay. And I guess that another question would be, there was a lot of data presented by Diavik, but what was the cost per megawatt to produce that, and what was the payback, and what's the IRR? These are the things it's nice to talk about. Well, why isn't this adopted, and where are the mining executives? But what's the real nuts and bolts of this? Thanks.
So it's a really complex question because, solar or wind, it all depends on the resource and the jurisdiction that you're going into. So I'll talk about Chile. We have a lot of activity going there, and I'll talk about a very large project in the northern grid, if you're familiar with the SING. We have I guess this isn't good in a microgrid forum, but large-scale solar is today in Chile competitive with coal. So again, it depends on tenor of contract, PPA, risk, irradiation. There are a lot of factors, but we can competitively sell power to the grid in northern Chile for $65 a megawatt hour. When you go to the other end of the spectrum, which is what I was promoting up here today, that varies a lot by logistics, size of the installation, and in tenor on contract. We're prepared to go in at kind of megawatt scale installations into legacy microgrids and, let's just say, sell power at a reasonable discount to legacy diesel generation costs. So, 15-20% discount to what it's costing for diesel. But that's a very different model, and it's a higher risk, higher return model for us. So it really depends on the situation. It's really a loaded question because I could give you any number of scenarios. Give me 30-year financing at 4%, I can go even lower. So does that help?
So I can answer the second one. So 2 years ago, I presented on the full financials, so I don't want to repeat it this year, but I can give you the high level. So for a project of about 9.2 megawatts, our capital cost came out at 31 million. And when we work on a diesel price, in our case, it's $1.25, $1.27 per liter, and our tariff around 0.32 dollars per 32 cents per kilowatt hour, and a conversion rate of 0.2445 liters per kilowatt hour. And then the other component is what we call a profitability index. So what is your NPV over capital? And Rio, we like it 1 or above. In this case, we're sitting at 0.9 for this type of project. So in terms of our country risk, we look at 7 to 8% that is needed for return. So we were quite above that, and the IRR being in the high 20s, and the payback initially was just short of 8 years, which is reducing significantly. The double-edged sword is reduction in oil price, which is an input to the NPV model. So that does play a bit with a payback period, but we work around 7 years for this project. And that was a conservative estimate, as our current gigawatt hours exceed the NPV model number. So those would be the high metrics. I think the other key component is how quickly one can construct, which contains your capital cost or your project cost. And doing a lot of innovation in-house. We didn't outsource it. We engineered it in-house, keeps your capital cost in check, as well as the phasing of construction. Again, there are many factors that can cause blowout of costs. And it's knowing what they are, specifically with regards to, these are the day-to-day things we had to deal with. These foundations required massive concrete pours. And once you assign your batch plant to it, we do absolutely no concrete supplied to our underground mine for CRF. And you can very, very quickly disrupt your mining cycle, or you contract out a batch plant, bring it to site, more cost, or you just optimize to the last digit and you keep your construction costs right down. So that's how you keep your capex in check. With these projects, capex can very quickly go high. They seldomly go low. You need to put in a lot of effort to get the capex down, which we have. But in terms of KPIs for the project, I think those are probably the big numbers.
That's a great question. Thank you. Any other questions? All right. Thank you, everyone. Thank you, Bill. Thank you, Sean. Oh, I think, is there a question? Oh, all right, sure.
Yeah, it's kind of just talking to the light.
Liesl, specifically, I would like to talk to you after you are done here. I'm the CEO of StarCore, and we're a developer of SMRs for remote operations and mining sites as well. Generally, what I'm curious about, though, is for solar and for wind, in terms of your experience, both Sean and Liesl, has your experience proven that that the overall NPV of the project is going to get down to the levels, because what we found is that in going to the investment community and to the potential purchasers of the products, is that they're looking for shorter timeframes, like 3 to 5 years in terms of returns. And what's your expectations about trying to, or the ability of those to then meet those kind of targets, if you will?
So our return expectation, again, it comes down to the client quality and tenor of contract. So solar has become very, very competitive, and the 20-year PPA with creditworthy off-takers is becoming more and more rare. 3 to 5 year paybacks on a PV project. I don't know. I've never seen one. I think I guess unlevered returns, if we're talking about that. You'll see a range in the U.S. where it's actually going below 8%. Those are grid-tied projects, to North Africa, West African locations where you'll have to get into the high teens to accept the levels of risk. So I guess I would say that's the range. And then as you get into shorter contracts, you obviously have to push up the returns, and then you could come up with a creative kind of follow-on extension solution with your client to kind of step down their costs to meet both your needs. You know what I mean? So that's what we're seeing.
From my experience, it's very rare. The key competitor is low grid tariffs. If you connect it to the grid and you have a good tariff, there's very, very little chance your renewable project's gonna get the NPV, get the paybacks in those terms, 3 to 5 years you're talking about. We had an economic project because our diesel prices are so high. We have high costs of energy, high supply, high logistic costs. So that is the reason this project crossed the hurdle. But in generic terms, with the current cost structure, it's very, I have not seen them either. The other question one would get is, can't we just throw more assets at it? And the answer is no, because your utilization, if you sit with an asset that you installed and you're not utilizing that asset, you have unused capital expenditure that sits there. So you wanna size your solution that you're gonna get maximum utilization and hence cost recovery from it. So I don't see those dates coming up unless you have a very serious energy cost problem, and then you can get those returns.
Yeah, and just a follow-up comment. So kind of Germany and Spain really kicked off this solar revolution that we're experiencing today, the benefits of today. But if you look at the returns on some of those early projects in those markets, Spain in particular, there actually, I take it back, there were projects that were very, very high returns, where tariffs were put in place and costs started to drop faster than the tariffs adjusted. And actually there were projects with 20 to 30% returns. But the government defaulted and they renegotiated, and it's not a sustainable model. So nobody's going to get those returns forever. And they don't really exist.
Thank you. Any follow-up questions? Any other questions? Right here in the front.
Sorry, I'm the yeah. Yeah, I have a question about. It's maybe evident, but if you look at wind for a greenfield application, let's say you're planting a mine somewhere. I think it's probably important to bear in mind that there's no way that you could look at wind or solar and the capital cost on a greenfield project without incorporating the cost of traditional spinning reserve. And I think that that's something to kind of bear in mind. Renewables, and I'm a big advocate for them, but renewables work where the capital tends to work where you have that in place. And I think that when you run renewables and you have a wind turbine running, or turbines, and I've seen this in reality, is that you have a diesel asset typically operating, but because of the spinning reserve, you still have the maintenance on that. And your overall diesel system now decreases in its operating efficiency. And that's something that I think needs to be kept in mind in all this. And again, you know, I'm not looking for hurdles here, but I think that, you know, the happiest customers are those who have no surprises 2 years down the road. Okay? And also, Sean, Scott, whatever you want to go by today, when you defined region before to this man's question, you talked about maybe $65 a megawatt hour in some parts of the world, and obviously higher north of there and other places. How do you define region? Is region simply the potential, the solar potential going from the equator to the North Pole in the extreme? Or is region, you know, what are the parameters you define region? Is it, you know, beyond, you know, moving the same piece of equipment to different latitudes or whatever, or different wind or solar potentials? Is it also, that 65, is it also considering incentives? Is it also considering the construction costs that Liesl brought up, which are very good, obviously, harsh environments typical for the miners? You have to go, how do you define region? I think that's important, because when people are thinking about renewable projects, they need to be thinking about, you know, what are the issues there beyond, you know,
Sure.
simply moving the same 2 megawatt unit from here and getting 27% net out of a wind turbine here versus, I think pretty astonishing, what I calculated quickly is 23% net out of the unit at Diavix. I think that's about right, about 23%, give or take a smidge. Yeah, I mean, that's pretty amazing. I mean, that's pretty amazing.
Sure. So to go back to your first point, you know, how much solar or wind and storage that you can put in place to mitigate your spinning reserve component. You know, it's driven by your cost of diesel and the declining cost of the renewable choice that you have. And I agree, in an off-grid scenario, you're not going to eliminate diesel or the need for that security. No, I get it, sure. But technology is improving very quickly. And a point will happen where, you know, if oil, I guess we have the view that, I mean, oil is cheap today, but if you look at long-term averages, you know, things tend to level out and it will increase over time. And if you look at the cost of solar and storage and kind of Moore's law of, you know, declining costs for these types of technologies, I mean, we've already really kind of, we're hitting that point where we can offset diesel with these technologies. But at some point you'll go far past that and you just overbuild. And sure, you can keep the gen set in place just in case you have 2 weeks of utter darkness and the wind doesn't blow. But we believe the cost will come down. I mean, we're just at the beginning of this change, okay? To your question on jurisdiction. So it's a question of risk. For large non-recourse project finance projects where the counterparty is a government or a national grid, it's country-based. Credit of the off-taker, country stability, those types of things. For this community, the mining community, I tend to look at it differently, and some of our board members do as well, in that you know, large multinational mining companies, we would look at them as the jurisdiction as far as, you know, if we can de-risk the credit problem outside of a volatile country or a place where, you know, we have concerns about the credit risk of a project with a strong commercial counterparty, you know, you can look at it both ways. As far as jurisdiction on, you mentioned incentives. So I brought up Chile because that's really the first market in the world where there's really no incentive. There's a small incentive, but it's not significant. And it's a true market-based energy grid. So it's, and solar is competitive. It's so competitive, they're driving the daytime cost down because there's been overdevelopment and solar is becoming a lot cheaper. And then there's some other factors that you mentioned. I mean, there's a radiation resource that happens to be the strongest irradiation on the planet and other things. But, I mean, yes, incentives help. To be honest, everything has an incentive. You know, traditional, you know, nuclear, coal, wind, solar, everything. They're all incentivized somehow. Some are hidden costs, or some are hidden incentives, some are not. But the nice thing to see in our industry is that the incentives have worked. And it's worked for wind, at least, if we talk about the States, and it's worked for solar. There's a big argument in our space right now where in the US there's an investment tax credit of 30% that's coming to an end at the end of next year. And people are concerned about the collapse of the solar market in the States. And honestly, I think the credits have worked. If they extend it, great. But the cost is so low now that as long as the other competitive technologies don't also get subsidized through some other method, and you truly levelize the real cost of energy production, great. Let's compete on a level playing field. So.